Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kimco Realty Corporation Annual Report. Kimco Realty is a leading real estate investment trust that specializes in owning and operating high-quality shopping centers and mixed-use properties across the United States. The company's portfolio consists of over 565 properties, totaling 100 million square feet of gross leasable space, strategically located in the first-ring suburbs of major metropolitan markets. The company's business model focuses on essential goods and services that drive frequent customer visits, such as grocery-anchored shopping centers. This tenant mix is designed to provide a stable source of revenue for the company. In addition to owning properties, Kimco Realty also offers various services, including property management, acquisitions, and value-enhancing redevelopment activities. As a publicly traded company listed on the NYSE since 1991, Kimco Realty has established itself as an industry leader in corporate responsibility. The company's commitment to sustainability and social responsibility is reflected in its business practices and operations. With over 65 years of experience, Kimco Realty continues to be a major player in the real estate investment trust sector. The services provided by Kimco Realty include property ownership, property management acquisitions, value-enhancing redevelopment activities. The company's portfolio consists of shopping centers and mixed-use properties that offer a range of essential goods and services, including grocery stores, restaurants, and other retail establishments. Kimco Realty Corp's stock price has experienced a significant increase in the past year, with a 12.04% year-to-date gain as of February 17, 2026. Several key events have contributed to this positive performance. The company's strong Q4 2025 financial results were a major catalyst for the stock price increase. Kimco Realty Corp reported robust earnings and revenue that exceeded forecasts, leading to a 2.65% jump in its stock price during pre-market trading. The company also achieved an all-time high portfolio occupancy of 96.4%, and a 6.7% increase in full-year funds from operations, FFO, to $1.2 billion. In addition to the strong financial performance, Kimco Realty Corp's decision to hike its quarterly common dividend by 4% for 2025 was also well received by investors. The company reported record overall portfolio occupancy and its highest quarterly new leasing volume in over a decade, further boosting investor confidence. The stock price reached a 52-week high of $22.99 on February 17, 2026, reflecting investor optimism about the company's prospects. Analysts, including Stifel, have also raised their price targets for Kimco Realty Corp., with Stifel increasing its target to $25.75 from $25.50 and maintaining a buy rating. Increased institutional investment in Kimco Realty Corporation has also contributed to the stock price increase. Several prominent investors, including Aberdeen Group plc, Medes Global Partners LLC, and Varma Mutual Pension Insurance Co., have raised their stakes in the company during the third quarter. Kimco Realty Corporation market capitalization of $16 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that Kimco Realty Corporation holds a significant advantage in their industry. Kimco Realty Corporation trades at a higher price-to-earnings ratio of 28 times and a higher price-to-book ratio of 1.5 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. the company have a dividend yield of 4.49%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, acquiring new properties through acquisitions and increasing the number of unencumbered VIs is a significant driver. Improvements to rental properties, such as renovations and upgrades, also contribute to revenue growth. Additionally, growing gross leasable area, GLA, due to acquisitions, developments, or expansions can lead to increased revenues. On the decline side, selling properties and recognizing losses on sale through dispositions is a major factor. Recognizing impairment charges on assets, such as properties or investments, also contributes to revenue decline. Furthermore, settling disputes or claims that result in losses can negatively impact revenue. It's worth noting that while interest rate swaps and embedded derivatives are related to financial instruments and hedging activities, they do not directly impact revenue growth or decline. Capital expenditures, including acquisitions, improvements, and other capital outlays, can also influence revenue growth or decline. Overall, the value of assets and liabilities plays a crucial role in determining revenue growth or decline. The changes in net income and profit margins over the past year have been inconsistent. On one hand, net income has increased by 47% from $375.7 million to $554.4 million on page 31, indicating a significant growth. However, on other pages, such as page 135, it decreased by $178,712, showing a decline. The estimated decrease of 10.7% from 2024 to 2025 on page 130 further supports this mixed trend. Profit margins have also shown a mixed trend. On page 122, the net income as a percentage of revenues increased from 20.8% in 2024 to 27.8% in 2025, indicating an improvement. However, the NOI at share as a percentage of revenues decreased from 78.7% in 2024 to 78.2% in 2025 on the same page, showing a slight decline. The estimated decrease of 1.7% from 2024 to 2025 on page 130 further supports this mixed trend. The inconsistency in net income and profit margins can be attributed to various factors such as changes in revenue, expenses, or market conditions. Despite the mixed trend, some pages indicate a growth in profit margins, with an increase from 28% in 2024 to 32% in 2025 on page 107. Overall, the data suggests that while there are signs of improvement, the net income and profit margins have not shown a consistent trend over the past year. The company's financial performance indicates a consistent generation of positive operating cash flow. This trend is evident across multiple pages, including page 26, where it is explicitly stated that the company is generating positive operating cash flow. Similarly, on page 30 and page 36, the same conclusion is drawn. Furthermore, the company's ability to satisfy its debt obligations by 2026 through net cash flow provided by operating activities, page 41, suggests a stable financial position. The repetition of this statement across various pages, including page 42, reinforces the notion that positive operating cash flow is a recurring theme in the company's financial performance. The conclusion on page 78 reiterates that the company has generated positive operating cash flow in all 3 years, providing strong evidence to support this claim. Additionally, pages 85 and 108 explicitly state that the company is generating positive operating cash flow. The consistent message across these pages underscores the company's ability to generate sufficient cash from its operations to meet its financial obligations. In summary, the overwhelming evidence suggests that the company is indeed generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past few years. In terms of debt level, the company has seen a substantial increase in its total debt, reaching $1,419.2 million as of December 31, 2025, up from $1,473.7 million in 2024. This is largely due to the issuance of new senior unsecured notes and term loans, as well as the acquisition of an operating property. However, the company has also made significant principal payments, with a total of $7,776,300,000 due between 2026 and 2030. Interest expenses have also increased significantly, rising by 32.1% from 2023 to 2025. The interest expense for 2025 was $80.1 million, up from $87.5 million in 2024. This increase is largely due to the floating interest rates on variable rate debt and the company's growing debt level. Overall, while the company has made efforts to reduce its debt through principal payments, its increasing debt level and interest expenses remain a concern. Management is prioritizing growth through strategic investments in real estate properties, as evident from the company's significant cash flow from operating activities. To achieve this goal, they are implementing a capital recycling program to dispose of lesser quality assets and optimize their portfolio. In addition to growth initiatives, management is actively managing the company's debt structure by reducing the impact of interest rate changes on variable rate debt through interest rate swap agreements. They are also committed to maintaining the company's REIT status, which will exempt it from corporate federal income tax if dividends meet certain requirements. Furthermore, management is focused on incentivizing employees through new equity participation plans with increased reserved shares for stock options. To manage risk and stabilize insurance costs, they have formed a captive insurance company, KIC. They are also aware of the tax implications of their investments and have retained proceeds from the sale of ACI stock for general corporate purposes. Overall, management's strategy is centered around growth through strategic investments, debt management, REIT status maintenance, employee incentives, risk management, and optimizing net operating income (NOI). The company has made several significant acquisitions and divestitures over the past few years. In terms of acquisitions, the company has purchased various properties and investments, including Weingarten Realty Investors in August 2021, 3 operating properties for $218.4 million, and a preferred equity investment of $12.7 million as part of the RPT merger. The company has also acquired mortgage receivables and assumed non-recourse mortgage debt on several properties. In addition to these acquisitions, the company has made significant investments in various properties, including operating properties with assumed non-recourse mortgage debt of $31.4 million and $164.6 million. These investments are expected to generate revenue for the company in the future. On the other hand, the company has also made several divestitures, including the completion of its exit from Mexico and Canada operations. The company has sold 4 operating properties and 6 land parcels for $108.6 million, as well as disposed of operating properties during 2025 and 2024. These divestitures are expected to reduce the company's liabilities and improve its financial position. Overall, the company's acquisitions and divestitures have been significant and far-reaching, with a focus on expanding its portfolio of properties and investments while also reducing its liabilities and improving its financial position. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which it has done consistently as evident from multiple pages in the extracted summaries. This indicates that the company values its shareholders and is committed to providing them with returns on their investment. In addition to paying dividends, the company has also been proactive in buying back shares. A notable instance of this was mentioned on page 27, where it was revealed that the company repurchased a significant number of shares for substantial amounts. This move not only boosts shareholder value, but also demonstrates the company's confidence in its future prospects. Concerns about inventory buildup and supply chain disruptions are prevalent in various aspects of business operations. Disruptions and increased operating costs due to inflation and supply chain issues have been noted, particularly on page 2. Supply chain constraints, tariffs, and labor shortages further exacerbate these concerns. Supply chain disruptions can impact timely delivery and profitability, as seen on pages 12 and 16. The report highlights significant increases in materials, parts, and labor costs over the past year, which could lead to inventory buildup if not managed properly. Temporary or long-term disruptions in tenants, supply chains from local and international suppliers may also result in delays in delivering inventory. The repeated mention of these concerns throughout the report underscores their significance and potential impact on business operations. Addressing these issues is crucial to maintaining efficient supply chain management and mitigating the risks associated with inventory buildup and disruption. That concludes the financial summary for Kimco Realty Corporation. Feel free to comment below, and I will be happy to answer them when possible.